trade uncertainty is making headlines. With proposed tariffs on China, which could be as high as 60%, and tariffs on other emerging market countries, the question remains, how could that impact the prices we pay for goods here in the U.S., and what impact could it have on your investments? Could EM emerge more strongly, or are there choppy seas ahead? We're going to break it all down for you right here on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you so much for joining us today. My guest in the studio is Xing-Chen Yu, emerging market strategist with CIO Americas here at UBS. Xing-Chen, good to have you back in the studio.
It's great to be back.
Yeah,
it's
good
been
to
a
have
long
you.
weekend.
Yes, it is. It's been a long couple of weeks since we started the new year. So much going on. I do want to start though with, we've got Trump and his administration, President Trump, back in the White House. So we're calling it Trump 2.0, which I think everybody is. But obviously there is a lot that's happening in conversations, mostly about tariffs. There's other things happening within what you cover, which is the emerging market space, countries and the investments within those countries. Maybe you can just kind of give us the download, what we need to know right now on the latest developments here.
Sure, happy to. Maybe to set the stage, right? I think one thing for sure is markets do not like uncertainty. Performance for emerging market stocks before and after the presidential election in November was quite divergent. There is uncertainty related to trade policy, obviously, which is on top of a lot of people's mind. There's also uncertainty related to U.S. domestic policy, which could have ramifications for U.S. dollar and rates. That also matter for emerging markets.
So I want to focus on trade a little bit because I think that's one of the things that's really on people's minds. I mentioned right in the intro that probably a smaller percentage, and we would call it highly aggressive, would be a 60% tariff on China. And let's talk about China specifically in a moment. But there are other countries, Mexico, even Canada, that have been, mentioned by Trump and his administration. So walk us through the baseline scenario that we have in here in CIO on trade and how it could impact emerging market companies.
Absolutely. So let me just firstly stress that staying diversified is very important still in portfolios, because at the end of the day, we don't know what is going exactly to happen, particularly on the trade front. But as a baseline scenario, we're still penciling a fairly aggressive tariff regime with U.S. set to impose tariffs on China and also partly other trade partners as well. In case of China, we think the effective tariff rate will jump to 25 to 30% from 10 to 15%. As for other trade partners, it's going to be a selective-based approach. For instance, maybe European autos, including EVs, can be impacted among others. Now, we can also not rule out a very aggressive scenario where a universal tariff regime is going to materialize in this case, in which case the global growth impact will be much more visible. Now, when it comes to implications, right, for emerging markets and Asian companies, there are several sort of angles we can look at. I mean, one is to look at how vulnerable they are from a revenue standpoint. I mean, looking at their revenue exposure in the U.S. Of course, not imports are created equally. I mean, the nature of the products also matter when it comes to displacement risk, when it comes to whether the products are substitutable or not, right? So looking at EM as a complex, you got Taiwan, Korea, Mexico running a relatively higher U.S. revenue exposure, but at the same time, places like Taiwan, for instance, the AI chips coming out of there are difficult to substitute. On the other hand, we can also look at the valuation impact, particularly in the short term. Going back to 2018 to 2019 trade escalations, China were the one that were hit the hardest,
right?
Along with other stock markets that are correlated with the Chinese markets.
So let's stay with China. As you mentioned, the general probability of something like 50% from CIO is a 25 to 30% tariff rate on China. So here's, I think, the follow-up question, which is, what would that potential impact be on China as far as their response? Because we would expect that there might be some retaliatory efforts. There would probably be tariffs put on goods that we're sending to them, et cetera. So what do you think the overall impact would be if we did put a high percentage rate tariff on China, for example?
Sure. So maybe I think whether China will be the main target or one of the main targets this time around is debatable. I think given the changes around rhetorics against China from President Trump sort of has been evolving. But nonetheless, I think there are a couple of things to keep in mind. One is even if President Trump did not yet impose tariffs this time against China, there is an ongoing review of China's compliance of the Phase 1 deal, as well as the sort of permanent normal trade relations with China on the U.S. At a legislative level as well. So key date to watch is April 1st. And then when it comes to the tariff impact, of course, it varies with scenarios, right? On a baseline, we're penciling maybe 70 to 150 or 200 basis point of growth impact, and that can also go up to 300 basis point in case the trade scenarios becomes a little bit more aggressive. Now, importantly, as you highlighted, the responses from China will be interesting to watch because from a countermeasures standpoint, we can think of some proportional retaliatory tariffs against U.S. imports. And we can also think of maybe export control as well of critical minerals and even some selective technology. In an extreme case, maybe sanctions against American companies. Although I have to say that China has been sort of promoting itself as a globalist, particularly in light of all this sort of rewaking of the global protectionist policy originated from the U.S. So I don't think at the end of the day, China will use ultra-aggressive protectionist policies in this sense. Now, when it comes to some other consideration, there can be also offsetting measures. One is maybe the yuan depreciation on the currency front can help offset some of the impact. And also, importantly, using domestic economic policies, right? Stimulus on both fiscal and monetary front to sort of offset the impact. Now, one last thing I want to emphasize is there are also other non-trade related disputes that should also matter for financial markets. Because you go back 4 years, when President Biden took the office, even if there were limited trade escalation between the two largest economies, there were a lot of non-trade related disputes ranging from financials, export controls, what have you, right? And this kind of headline news or the implementations of these restrictions also matter for assets, particularly Chinese assets, because if that's the continuation of the policy, that means we're likely be heading towards a likely financial decoupling situation.
Right.
Yeah.
I mean, when we look back also at 2021, when Biden took the office, like you said, we were all still in the middle of a very tense situation with supply chain issues because of the COVID pandemic. So it's, not exactly comparable, but there were some issues that were outstanding. And subsequently, you talked about universal tariffs. That could come up against some legal challenges. So I think there is the possibility that there will be something. Who knows? And as you said in the report, CIO says there is a 10% chance that the U.S. and China could reach some kind of a deal that's more benign. So a lot of, as you said right at the beginning, markets don't like uncertainty, neither do we, but we do have a lot of unknowns in front of us. So that being said, Xingchen, as we wrap up, what are some of the highest sort of conviction calls that you and the team are discussing right now when it comes to investing in EM? And we haven't even mentioned India, which, by the way, their real GDP is expected to be 6.3% this year. To compare that to the U.S. at 2.1%. So that's still a growing economy. Lots of opportunities there, too.
Sure. I think as a whole, we are neutral on emerging markets. We think clarity will emerge maybe later down the road. And in the short term, we expect volatility to stay heightened. But being selective is also important. we think there are opportunities, particularly in Asia, for investors to look at. For instance, Taiwan. I talk about the difficulty of substituting Taiwan's AI chips, particularly its manufacturing capability. And also India, as you highlighted. I mean, admittedly, India has pulled back since maybe the second half of last year due to some earnings concern. But however, we're seeing some of the bottoming signs of earnings, and now the entry point seems to be a little bit more interesting from here, plus some of the structural tailwinds that are likely to here to stay.
Terrific. Great to have you here, and I'm sure we'll be talking a lot more about everything happening in the EM world over the course of the next few months. Thanks for coming by.
Always a pleasure.
Great.
Thank you.
Xingchen Yu again from the Chief Investment Office. And for more information on anything coming out of UBS and our CIO, visit our website at ubs.com/views. Plus, you can follow UBS on social media. We're on all the channels, including Instagram. Follow us at UBS Trending. Lots of studios content there for you to follow. And as always, if you have any questions about what Xingchen and I spoke about today, make sure you are having an open dialogue with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, and remember to keep your eyes on what's trending. We'll see you soon.